The Rebel Capitalist Show.
What do you think the systemic risks are for the real estate market in China collapsing for the rest of the world? I mean, the first thing obviously that comes to my mind is Australia. Their exports, I believe 20% of their exports are iron ore. And so if 50% of the demand, let's say globally for iron ore is coming from China, and that's a result of this ever expanding real estate bubble, if that bubble bursts, I mean, how does it affect their China's imports, therefore other countries' exports, and what does that do to the global economy?
In terms of how it's going to affect global macro and markets, you're already seeing that now with base metals. So that's going to affect Australia. You've seen Rio Tinto shares drop a lot. I think the dividend yield's at 10%.
Yeah.
The question is, how long are base metals going to stay low? And are the base metal producers, are they going to cut costs? Are they going to bring on production? Are their dividends sustainable? It's a tough question because we're going to have to see how China decides to handle the bailouts. They are definitely going to bail out the banks. Okay, the real estate developers, they're going to let those debts get wiped because the foreigners, the bond fund guys, and unfortunately, there's a lot of Americans and Europeans and other foreigners who were suckered into this with their retirement accounts to buy these global, to buy these emerging market bond funds, right? And they have way too much exposure to China's real estate market. But the Chinese banks, they're going to print. They're going to print whatever it takes to bail out banks inside China. HSBC.
I was going to say, what about HSBC?
The key for China to do this, if they're going to print that much, if they're going to print trillions, they have to manipulate their exchange rate. Because if China's currency gets really weak too quickly against the dollar and the euro, you're going to have a lot of people pay very high money laundering fees to try to take currency out of China, to try to get their savings out of China. And that's already been happening, but that will accelerate. And I think that's why, George, we just had this crypto announcement for China, because they're anticipating this. They're anticipating trillions more. They're anticipating
not money laundering, but basically capital controls.
So the Chinese government is anticipating that we're going to have to do all these bailouts for the banks now. We're going to have to print trillions. We're going to have to make the banks whole. They're going to write off their bad debt, but we're going to have to print because they have all this shadow banking exposure that's all tied to real estate. Trillions. So they're going to print. So they're trying to increase the capital controls and make it harder for the average Chinese citizen to get their savings out of China for a currency devaluation. That would be my opinion.
Yeah, so capital controls. But then how do you think they handle HSBC? Because it's not government, that they've been at odds in the past. Do you think they just let them go bust?
If you speak to Kyle Bass, and he has sources on this, he says the Chinese government hates HSBC Bank. He's also spoken with people at the Bank of England who supposedly hate HSBC Bank too. So I don't know who's so
no central bank buddies.
Well, here's the thing about HSBC Bank for your listeners who are not familiar. There's an episode on the Dirty Money documentary series on Netflix, and it talks about HSBC Bank should be the corporation here in the US that has the largest fine. It's Pfizer right now. I think it's 1.9 billion. That's the corporation that's paid the largest fine. It should be HSBC Bank because they've knowingly been laundering for decades, many billions of dollars per year for terrorist organizations, drug cartels, organized crime. And yet they barely paid, I think, $1 billion fine. And there were no criminal charges. So there was an enormous amount of corruption. James Comey was hired here in DC as a fixer. He was put on the HSBC Bank board of directors for about 18 months. I think from the public filings, he was given about $6 million worth of cash and stock options to negotiate a deal with the Department of Justice to get all the felony charges dropped. But the documentary episode on Netflix, it only talks about a small amount. The real number is much, much larger from what I've heard of money laundering that occurred. This is one of the worst banks. This bank has a lot of political enemies.
Right. But so I'm just trying to think this through. If they go down, let's say they're out of the equation temporarily or maybe permanently in China, then how does their real estate market come back online? Because it's so driven by debt and the expansion of debt. And, I was reading a statistic the other day that in some of these urban areas where there's just these huge, huge property bubbles, the average cost of a house or an apartment is 46 times the annual income. 46 times. And the only way that people can afford the debt or the mortgage is because they assume they'll be bailed out by capital appreciation. So if you have that happening,
I don't know how
how
central planners are going to fix that. I don't even want to try to think about how central planners are going to fix that. Look, the whole thing's a bubble.
Yeah.
The whole thing's a bubble.
Yeah.
They figured out how to keep it going longer than a lot of people thought.
Right.
Can they change the rules? Can they print more? Can they maybe forgive, similar to what the US with student loans? Can they forgive some of those mortgages? Can they maybe figure out a way so younger adults will buy these things? Maybe. But younger adults now in China with the bans on crypto for regular Chinese people, with the what the government's doing there with Chinese stocks, a lot of young people now, George, and we're just seeing this in the data in the last month, they're buying physical gold. Now the paper gold price here in the US in US dollars, that's getting smashed. The Fed's balance sheet's going up, but the gold, the physical demand numbers, whether it's central bank net purchases globally, there's an enormous amount of central bank demand for physical gold. The physical gold purchases for demand in India and China and Asia are all back to 2019 or higher levels. So we're seeing big spikes in the actual demand for gold that will precede a big move in price. The other thing I think we're going to see in the gold market is we're going to see, this is the first time in history too, by the way. I've been covering gold and silver for almost 15 years now. And the producing gold miners, so the larger ones and the mid-tier ones, they've never had this much cash and clean balance sheets without debt, good profit margins, even though gold prices smashed a little bit. It's down, $400 since a year ago. So it's still relatively high, even with oil prices rising. A lot of gold miners are still producing gold around $1,000 or $1,100 an ounce. So the margins are still really good. You're going to see cash flows right now, and no one wants to talk about this because they're hated. The gold miners are hated. All the global macro fund managers are all shorting gold. They're talking about how they're hating gold. You're seeing news story articles about this BlackRock portfolio manager just dumped all his gold holdings. Yeah, he dumped GLD and Barrick Gold. That's probably all he owned. Because the majority of these global macro guys, right, that say they're bullish gold, they don't buy any metal. They don't do any research work on any quality gold stocks because they're managing tens of billions of dollars. And the only thing that they can buy without moving the stock price is they buy GLD or they buy Barrick Gold. That's pretty much it. Or maybe they buy a gold ETF like GDX or one of those. So those are their only options when you're that big. But for the smaller investor, there are incredible bargains. There are companies selling between 2 and 6 times cash flow that are making a lot of money, that are raising dividends. You're getting paid to wait on some of these companies. You're getting 2 or 3% dividend yield, and the company's doing just fine. And they're going to go out in the next 6 to 12 months, and they're going to buy a producing gold miner at a very deep discount. So the shareholders of the larger producing gold miners, so these are not Barrick Gold. Obviously, I don't like Barrick Gold. I get questions like this all the time. How do you feel about Barrick Gold? I've never liked Barrick Gold. They were involved in the paper price manipulation. So your Kirkland Lake Golds, your Newmont Minings, your Agnico Eagles, some of the better run mid tiers, they're going to go out and they're going to buy quality gold assets. And 2 or 3 years from now, they're going to be minting money. Yeah. So yes, in the short term, things can go down. But the Denver Gold Forum was last week. That's one of the biggest gold conferences in the world. And the stuff I was hearing from gold company CEOs and gold fund managers that were there or spoke to the gold company CEOs, there's going to be the largest acquisition boom in the next 6 to 12 months. You've never seen acquisition boom like this before because the gold miners have never had cash to go buy assets, to go buy cash flows that are this deeply discounted.